The thing with variable annuities is to get some of those securities or some of those riders, you have to pay for them. So there's a cost attached with a variable annuity. So make sure with a variable annuity that you're at a place to be able to take some risk with your underlying investments with a variable annuity.
Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Well, hello, everybody, and welcome to another episode of Reynolds Wrap. I'm Don Reynolds, of course.
Corey Still. Hello, everyone.
So we thought we'd talk about annuities just because we haven't really talked about them in a long time. And, you know, there's definitely a fit for annuities. And, you know, there's really three different types. Well, I should say that there's four, really. And then, you know, you can deep dive into a little bit of each one. But you have immediate annuities, which are basically give money to the company. They guarantee you a paycheck back for life, or you can set up life in 10, life in 20, you know, however you really want to do that. Disadvantage there is, you know, you basically don't have growth to your asset anymore. They're going to, you know, basically set that payment on based on current rates and the formula they use to kick out what the payment will be. So, you know, back in the late 80s, early 90s, those were great because payouts were very high because interest rates were so high. Today, not so much anymore. So we don't really use those. We think there's better plays for people. And those are really called longevity annuities. Where now today, because a lot of the annuities have income riders that pay guaranteed payments for life as well, we think that's a better way to go because number one, your asset that's sitting in the annuity still has growth potential to it, even though you're taking out the income. Some companies actually have increasing income too, which will help keep up with inflation. So we think that there's a great fit for that. You know, we call it pensionizing people's IRAs. One of the biggest fear people have today is, will they outlive their savings? Yeah. Well, that kind of takes that off the table because you got a guaranteed paycheck, kind of like a pension.
Yep. And that's most common where an immediate annuity is it's a pension maybe from a company where they'll take a set dollar amount that they put aside for your behalf as you're working there, and then they transfer that money in trust to an insurance company, which promises a paycheck for, of course, for your life and whatnot. You know, the key with annuities is Don mentioned is that word pension. And as we're seeing, I think the latest statistic is about 14% of retirees have a pension. So obviously they're diminishing, and annuities are an investment vehicle that we really need to explore, especially if there's an income gap. When you look at what you may have or may not have for a pension, what your Social Security benefit is, and what your budget would be. What do you need for income? And then, of course, you know, fulfilling that shortfall with something that you know will perform rather than what we hope will perform. That's the key there with an annuity, is if you've got that income gap, we'd rather know that we're going to have that coming in every single month rather than we hope it's going to come in with market investments. So another type of annuity going kind of through the four is a fixed annuity, very similar to a CD at a bank. It's just basically with an insurance company. You're promised a guaranteed rate for a guaranteed period of time. Right now in 2024, with a higher interest rate environment, we're seeing some very attractive rates. Silver lining to this inflation we've been through is that rates have come up. So CDs, I know, are paying well at a bank, but most of those are shorter term. You can, with an insurance company and a fixed annuity, guarantee a rate for a longer period of time, 2, 3, 5, even 7 years or longer with some companies. So again, some things to look at there. And the key word there, again, is you can't lose any principal. It's a guaranteed rate. There's no risk to your investment at all. And then I know Don will get into the fixed index, which is a category that we really believe in heavily here.
Yeah, fixed index, basically indexes, you know, S&P, NASDAQ, you know, Bloomberg, PIMCO, they have indexes out there. Morgan Stanley, there's a lot of them. And so that's how those contracts, if you will, make returns. It's based on how the indexes perform over the course of the year. Again, you've got guarantees. That's where the fixed piece comes in. You can't lose your principal, so you got a floor of zero, so to speak. Other thing about some of those, they have what we call a long-term care rider that are built specifically right into the contract. There's some parameters about how they work, but if you've already got the income benefit turned on, and then you land in a nursing home and you meet the criteria, the ADLs and such, it'll actually double that payment for you. And it'll stay doubled until the value goes down to a point where there's no value. Well, then the payment will actually reduce to what the original payment was when you started it. And that's still guaranteed for life. So that, that can be a great fit for people as well. And then variable annuities, we'll let Corey talk a little about those.
Yeah. So a variable annuity is the word variable, just means exactly that. Often your principal is at risk with market volatility. It's no different than having investments in a market. Usually you have a sub account or an investment choice, and that value can go up or it can decrease in a stressed or a down market. Now, there are different riders you can add to it, which would be income benefit riders or death benefit riders. The thing with variable annuities is to get some of those securities or some of those riders, you have to pay for them. So there's a cost attached with a variable annuity, and often they can be quite exhaustive. So make sure with a variable annuity that you explore, again, the cost, the fees associated with that, and that you're at a place to be able to take some risk with your underlying investments with a variable annuity. Real quick, back to the long-term care piece too. Often we will use those or look at those as a hybrid for long-term care, as Don said, with the options there. Another way to use that would be if we put money into an annuity and we don't turn that income on until someone entered again, a nursing home or needed that type of income, we could turn the income on at that point too. So we can defer income until a set date or set time in someone's life if they so choose. And of course, with deferral, the income usually goes up as well each and every year with growth within that fixed index annuity or the different categories of the annuity. So
yeah, and the only thing I'll just clarify, you have to have the income benefit turned on in order for it to qualify for the long-term care benefit. That's
correct.
Just one of the keys. Just, again, we want to make sure we're giving you all the facts.
Yep.
And then the last, and really there's different types of annuities you can use, but it's called a charitable gift annuity. We've used these in the past. People will use what's a charitable remainder annuity, for like if you own properties. It's a little bit different, but what it really does is it helps the capital gains. Where a charitable gift annuity, what you're doing is you're putting money into the annuity, and depending on the situation, you're going to receive lifetime income through that. And you also potentially could receive some tax benefits early on with that. And some of the payments might also be tax-free. So, and then if there's value left at the end of the term, it's going to go to the charity you designated. So again, if charity's a big thing for you, which we know a lot of people that's important, that certainly is something you could maybe take a look at too. So, we just want to give you a high level view. Again, what we always say is if you have a question about this, give us a call at 651-773-3859. Again, that's 651-773-3859. And we'd be happy to share our thoughts and insights and answer your questions that you may have.
Yeah, absolutely.
With that, thanks,
folks.
folks. Yeah. We'll see you next time. Y'all take good care now.
Have a great day, everyone.
Bye now.
Listen to more with Don Reynolds and Corey Still on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.